Imagine an economy where the rules simply stop working. Prices rise, but businesses don't thrive. Jobs disappear, yet inflation refuses to slow down. People wait for relief that never arrives. And the experts, the central bankers, the politicians, everyone keeps assuring the public that everything is under control. But underneath the calm promises, a disaster is quietly brewing. That's the mystery of the 1970s, a decade when inflation and unemployment, two forces that were never supposed to rise together, suddenly did. A decade that broke economic theories, shattered public trust, and forced the world to rewrite its entire understanding of how money works. And the strangest part? Many of the pressures that created that crisis are happening again right now, just in different forms. To understand how stagflation became the monster no one knew how to fight, we have to rewind to a time when the global financial system still felt stable. It's easy to forget, but coming out of the Second World War, the world entered a kind of economic golden age. The United States dollar was king, backed by gold under the Bretton Woods system. Inflation was generally low, unemployment was manageable, and the belief that smart policymakers could engineer permanent prosperity was treated almost like scientific truth. Economists confidently argued that inflation and unemployment were opposing forces, bound by the Phillips curve. When one rose, the other fell. It was a tidy theory, the kind people like to teach because it makes the world feel predictable. But beneath this apparent stability, pressure was building. The United States had spent heavily in the 1960s on the Vietnam War, on new social programs, on an expanding global military presence. Spending grew faster than incoming revenue, yet no one wanted to admit that imbalances were becoming dangerous. Other nations noticed the United States printing more dollars than it could back with gold, and some began quietly demanding gold in exchange for their reserves. The system that had anchored global finance since 1944 was suddenly wobbling. Then came the moment that cracked everything open. In August of 1971, President Richard Nixon appeared on television and, with calm firmness, announced that the United States would no longer exchange dollars for gold. With that single sentence, the Bretton Woods system died. The dollar was no longer tied to a fixed value, floating freely for the first time. At first, many officials reassured the public that this change was temporary, just a minor adjustment. But it was the beginning of something deeper. A world where money lost its anchor, and inflation gained room to run. Once that anchor was gone, inflation started creeping upward. At first it seemed manageable, but each month it ticked a little higher. Businesses raised prices to keep pace with rising costs. Workers demanded wage increases to keep up with rising prices, triggering wage price spirals. Policymakers brushed it off as temporary. It was the same word you might remember hearing in the early 2020s when inflation resurfaced globally. The belief then, as now, was that once things stabilized, once supply chains normalized, once markets adjusted, everything would settle down. But the 1970s were not destined to settle. Because in the autumn of 1973, a geopolitical shock transformed inflation from a nuisance into a crisis. The Yom Kippur War triggered an oil embargo by OPEC, and overnight the price of oil roughly quadrupled. Suddenly, energy, the lifeblood of the modern economy, became scarce and expensive. Factories couldn't afford to operate. Transportation costs soared. Heating homes became a financial burden. It wasn't just that goods were more expensive. The basic functioning of the economy slowed down. And here is where the Phillips curve failed. Even as people lost jobs, even as the economy contracted, prices kept rising. For the first time, policymakers faced a reality they had never imagined. High inflation and high unemployment at the same time. Stagflation, a word that wasn't supposed to exist. With the crisis deepening, politicians scrambled for solutions. Some tried wage and price controls, commanding companies not to raise prices, and workers not to demand higher wages. It sounded bold. It sounded decisive. And for a short moment, it even looked effective. But controls became impossible to enforce. Supply shortages worsened. Black markets appeared, and inflation roared back stronger than before once the restrictions ended. It was like trying to put a lid on boiling water without turning down the heat. As inflation raged, confidence collapsed. The stock market fell by nearly one-half between 1973 and 1974. Bonds, normally seen as safe, were called certificates of confiscation because inflation devoured their real value. People who had saved for decades watched their purchasing power decline month after month. Worker strikes spread across industries. Policymakers tried stimulating the economy to reduce unemployment, but that only poured more fuel on inflation. They tightened to fight inflation, but the slowdown made joblessness worse. Every lever the government pulled seemed to break another part of the machine. Yet even in crisis, the breaking point still hadn't arrived. That came later, in the late 1970s, when inflation entered double-digit territory. Prices began rising so fast that households started adjusting their behavior, buying goods early before they became more expensive, demanding raises constantly, shifting savings into gold or physical assets. Expectations changed, and that psychological shift is what truly unleashes runaway inflation. Policymakers found themselves trapped. If they didn't act, inflation might spiral out of control. If they acted aggressively, they risked pushing the economy into a severe recession. Enter Paul Volcker, a towering figure both physically and economically, appointed as chairman of the Federal Reserve in 1979. Volcker knew that taming inflation required something drastic, something politically dangerous. He raised interest rates with brutal force, pushing them well above 20%. Borrowing costs skyrocketed. Mortgages became unaffordable. Businesses collapsed. Farmers protested with tractors outside the Federal Reserve. The recession that followed was one of the worst since the Great Depression. But the policy worked. The economy contracted painfully, but inflation finally broke. By the mid-1980s, the era of stagflation had ended. The cure had been delivered, but the pain was unforgettable. As the dust settled, economists rewrote their models. The old Phillips curve was no longer treated as a natural law. Inflation expectations became central to policy. Central banks gained independence to avoid political pressure. The world learned painfully that inflation is not simply about prices rising. It's about psychology, trust, and credibility. Once trust breaks, restoring it requires severe measures. But here's the twist most people miss. The story of stagflation didn't end in the 1980s. It echoes today in ways that are both subtle and alarming. Look at the patterns: rising global debt, supply shocks from pandemics to geopolitical conflicts, governments running large deficits, workers demanding higher wages amid rising living costs, central banks insisting inflation is temporary, asset bubbles in housing and equities. And underneath it all, a world dependent on cheap energy, cheap credit, and the belief that policymakers can always fix things before they spiral. In recent years, we've seen inflation surge globally to levels not witnessed in roughly 4 decades. Unemployment remained low for a while, but structural cracks, automation, demographic aging, slowing productivity suggest that downward pressure on jobs may still be ahead. Meanwhile, governments face limits on how much they can spend, and central banks face limits on how high they can raise interest rates without triggering crises. In other words, many of the conditions that created stagflation in the 1970s are reappearing, just rearranged for the modern world. We have different triggers, but similar vulnerabilities. The old belief that inflation and unemployment cannot rise together was shattered once. It can be shattered again. And here's the most shocking parallel. In the early 1970s, global debt stood at roughly 2/5 of world GDP. Today it stands at well over 300% of global GDP. The system is far more fragile, far more interlinked, and far more dependent on constant stability. If a major shock hits energy, war, supply chains, financial markets, a modern form of stagflation could emerge faster than most people expect. That's the unsettling lesson the past keeps whispering. The conditions for crisis can build quietly, one decision at a time, until the system crosses a tipping point that no one saw until it was already too late. So what should we take away from the 1970s? First, inflation is not a simple economic phenomenon. It's a psychological one. Once people expect prices to rise, their behavior accelerates the very thing they fear. Second, economic models are only useful until reality breaks them, and policymakers must be willing to challenge their own assumptions before the damage becomes irreversible. And third, financial stability is built on trust. Trust in money, trust in institutions, trust in leadership, and when that trust cracks, the consequences cascade through every part of society. The warning is this: history doesn't repeat perfectly, but it rhymes loudly. We may not see a carbon copy of 1970s stagflation, but the forces that created it are back in the global economy, disguised in new forms. Whether the world avoids the same fate will depend on whether leaders recognize the warning signs early enough, and whether ordinary people understand how fragile prosperity can be when the balance between inflation, growth, and trust breaks. If you found this story valuable, if you want to dig deeper into the hidden forces shaping finance and history, make sure to like the video, subscribe to the channel, and share this with someone who needs to understand how past crises shape the future. The more we understand these patterns, the better prepared we are for whatever comes next.